записувати.
Very good. So good morning, everybody. Let me introduce our dear guest today, Professor of Kiel University of Applied Science, Moser. He agreed today to talk to our professors and students and explain very interesting things about German taxation. Till, the screen is yours.
So, thank you so much. And basically, I'll just try to share my presentation here with you. Okay, one sec. So you should see my presentation there and me and a laser pointer, right? So we're good. Thank you so much. So yeah, thanks for having me. Basically, my topic for today is the German controlled foreign corporation rules, overview and areas of concern. That is basically what I will do my presentation on. But still, I understand from previous conversations that there is a high interest on your part regarding the basics of the German tax system as well. So what I would basically recommend, but first of all, las cavo prosimo. I wish you all welcome here, and I'm very happy to have you here, dear colleagues and dear students. But basically, this would be my agenda. So I would basically talk about that topic first and also answer questions regarding this specific topic, which is also quite relevant for you because it is my understanding that you just introduced controlled foreign corporation rules in Ukraine. And well, there are just some topics that might be interesting from the experience with the German CFC taxation. So that is why I think that is a rather relevant topic in that specific context for you. So please feel free to ask any questions you want. And after that presentation, basically, it's my day off today, so I'm really free to answer all questions. There is no time limit or so. So whatever you're interested in, you can absolutely ask me, and I have plenty of time to basically address all questions regarding the German tax system. Okay, so basically what I would do is I would outline some key materials that my presentation is based on, which you will obviously also get after the presentation. It's just my policy to hand out the presentation after the actual presentation in case I just find some additional typos or so, which pretty much every time happens. So, but you will always obviously also get the presentation. So then I would just briefly outline the purpose of CFC rules in general, which applies both to Ukraine and Germany, and then I would have just say some words about the historic developments of the German CFC rules. I would address the legal prerequisites and legal consequences of the German CFC rules, and then I would talk about some exceptions to the German CFC rules, which would also be interesting, I think, because Ukraine has introduced similar exceptions, so that might be interesting to compare here. Then we have some special topics: treatment of dividends and share sales, tax credit, what happens if you have basically foreign taxes or at the level of the CFC, and some areas of particular concern, and a short conclusion. That would be the agenda. So any further ideas on your part? Should I add something, or are you more or less fine with that agenda? Cool. I think you're probably more or less fine. So then I just would have two requests. First of all, if you have any questions, then please don't hesitate to ask. Absolutely, please ask. And I mean, Tetiana can translate. So basically, there's even the English language should not be a problem too much here. And the second thing is, this is my kind of. This is my thing, my area of research. So I tend to get carried away a bit. So please, if I'm too fast, if my English is too fast, please just tell me, okay? So I can absolutely slow down, but just you know that you are scientists yourself. I mean, this is basically what I just ask you to do. Just basically, if it's too fast, just tell me. And There's also this raise your hand function in Zoom. So if you have any questions during the presentation, again, please don't hesitate to just ask, and I will gladly answer these questions. Okay, so first the materials. So Germany just introduced the Anti-Tax Avoidance Directive Implementation Act. In German, Gesetz zur Umsetzung der Anti-Steuervermeidungsrichtlinie, which basically has the idea to implement the provisions of the EU Anti-Tax Avoidance Directive into German law. So basically, we were somewhat late there. We should have done that, I think, in 2018-ish, something like that. But the German lawmaker took its time, to put it mildly. And so we are just about done with that. So we actually have reformed CFC rules now. Basically what I would like to discuss mostly is these changes to the CFC rules. Then there's a paper from me and my colleague Sven Henschel, Reform of the Control Concept on the German CFC rules, Problem Errors and Open Question, which will be published in the December issue of European Taxation, journal on European taxation. And it's not published yet, so basically you are the first ones to get a presentation on that one. Okay, and then we have some German language sources, which are also quite useful in case you know German. I would recommend this paper by Böhmer, Gebhardt, and Krüger. Okay, these are the key materials, and now, let's just have a brief look at what controlled foreign corporation rules are basically about. Why do we need these kinds of CFC rules? Why are they pretty common, actually? Well, the reason is that under most tax systems, a corporation has kind of a shielding effect against the general system of profits taxation. For example, under German law, a corporation, be it a German or foreign corporation, is only subject to unlimited taxation in Germany if it has its place of management or its seat in Germany. So if it doesn't have its seat or place of management in Germany, it's at least not subject to unlimited German tax liability. And then if it doesn't have any income from German sources like a permanent establishment or real estate that is renting German real estate, then basically the whole income of this foreign corporation would be shielded from German taxation. So that would obviously lead to some tax planning approaches. So you might say, as a German shareholder, okay, I have some sources of income that are kind of linked to Germany, like I have a business here, that kind of stuff. But then again, there are also sources of income that are somewhat flexible, like interest-bearing bonds, that kind of stuff, securities, shares, or property rights regarding, basically patents or even foreign real estate. These sources of income are somewhat flexible. So what you can do is basically, from a tax planning perspective, under the general German, tax system, you could just, transfer these items that are related to these sources of passive income to a foreign corporation, preferably with a somewhat lower tax rate than in Germany. Because in Germany, you would be subject as a natural person, you would pay like a marginal tax rate of 42–45%, something in that range. And as a corporate shareholder, you would be subject to 50% corporate tax and additional 15% of trade tax. So you would be subject to like 30% taxation in Germany. And if you pick your foreign jurisdiction right, then that tax rate may very well be zero or a very low tax rate if you pick like tax havens like Barbados or the British Virgin Islands or whatever. So that is the idea, just shift these passive sources of income to foreign jurisdictions, to a corporation that has its place of management and seat in that respective jurisdiction, and you're pretty much shielded from the normal, basically, profits taxation in Germany. And the same goes for Ukraine. This is the thought that is behind you introducing CFC rules in Ukraine, because this problem pretty much appears in pretty much every jurisdiction that is not a outright tax haven and has an interest in taxing these sources of income. So that is basically the problem. And CFC rules, controlled foreign corporation rules, are kind of the solution to that problem. And that is why Germany introduced CFC rules as early as in 1972. So some words about the historic development of the specific German CFC rules. We actually introduced those in 1972, and they were not really changed too much since then, which creates problems in its own right. But still, I mean, basically we have the system in place, and there's plenty of experience, positive and negative, that you can profit from, because really this is one of the oldest CFC jurisdictions in the world. The one that is actually older is the Subpart F legislation in the US, but second is already Germany, so plenty of experience here, and not too many changes really. The one change we had was a reaction to the European Court of Justice Cadbury-Schweppes ruling, which basically said that the UK CFC rules are not in line with European law. The UK was back then was part of the European Union, so that was a decision specifically regarding CFC rules in a EU context. And as a reaction to that, we had some modifications. We had a substance test implemented, very similar to what you have now in your CFC rules. So that was the first major change. And then the second change is actually basically the implementation of the Anti-Tax Avoidance Directive that happened last year. Some words on that. This Anti-Tax Avoidance Directive is an EU directive which sets a minimum standard for all kinds of anti-tax abuse rules and for CFC rules in particular. So basically, what is worth considering is that you may absolutely have stricter rules than what the ETA provides, because this is a kind of a minimum standard. What is a problem is if you completely deviate from this ETA system, and Germany actually did that to some extent. So basically, that is where you really have to kind of adapt CFC rules if it's basically a completely different system. Being stricter is not so much of a problem, which is good for Germany because the German CFC rules are pretty strict actually. So that was luck for us. Okay, so that's where we stand right now. Any questions so far? Okay, so then let us have a look at when these CFC rules would typically apply, which prerequisites have to be met for the German CFC rules to apply. And basically we have three criteria. We have control. So basically a domestic shareholder has to control a foreign corporation. That's the first criteria. The second one is that you have to have these kind of sources of passive income. So if you have in a foreign country, say a power plant or a factory, that is kind of deemed as active because you think you may have reasons to set up a kind of a factory somewhere. But if it's interest-bearing bonds like capital income, rental income, that is not so clear. So passive income that is basically may be shifted to low tax jurisdiction for tax purposes. And the third criteria is low taxation. We'll come to that later, what Germany deems as a low taxation. But these are the three criteria, and I think this is more in line with what Ukraine introduced, more or less. So let's have first a look at the control concept. What does the German control concept require? It requires that at the end of the financial year of the foreign corporation, the unlimited taxpayer, which is the German tax resident, together with related parties holds more than half of the voting rights, or more than half of the shares, or we have a participation in more than half of the profits, or in the liquidation proceeds of that company. So we have four different concepts of control, and yeah, basically all European Union countries have introduced similar rules. So if that one of these criteria is met, then basically the CFC rules are yeah, maybe triggered. So one question for you here, considering that we have four different concepts of control, and considering that all EU countries had to implement similar rules, what kind of problem might arise here? What might be an issue?
I have a question.
Yes.
Regarding this voting rights and shares, let's say that, okay, somebody does not have 50% of voting rights, but has 50% of voting shares.
Yes.
Then what? So
more than 50%, that is. But if you have that, then basically, say we have this situation, and that leads kind of to my question. So thank you very much to that, for that. So basically, let's say this is Germany, okay? This is a German here, and then we have a foreign corporation. And what you're saying now is we like have 49% of the shares, and we have like 51% of the voting rights, okay? That kind of situation, that's what you have in mind. Yeah, bad news, German CFC rules apply, because you don't have to meet all four criteria, one is enough. Okay, so, but that leads to my question. What if the other guy is kind of, yeah, a French shareholder?
Exactly.
Yeah, this is a French shareholder, and she has like 49% of the voting rights. They are not related, okay? No relation whatsoever, but this one has 49% of the voting rights. And 49% of the shares. What do you think the French are going to do?
Nothing.
Yeah, you know, you have four criteria of control, right? And they have CFC rules. What kind of criteria would maybe be met here? Oh, sorry, I said 49. That's why you said that. No, they have 51% shares there.
Well, then yes, apply.
So basically the problem we have is that both the German CFC rules apply and the French CFC rules, which is a bit of a problem, right? So what we have created with this ATAT reform is kind of overlapping CFC rules. So these criteria overlap, and that is a bit of a problem, okay? So in Germany, we actually have introduced a clause that would say, okay, in that case, we see that, and we may basically credit taxes from foreign CFC rules against the German tax, but not everyone has introduced that, and it's not in the anti-tax avoidance directive. If you ask me, this is the one thing that is not in the ATAT. This is not in the directive. You don't have to do that, but that would be the first take-home message. You might introduce a clause that allows the credit of taxes under foreign CFC rules against the tax burden that you are levying, okay? Because this will definitely happen, okay? At least if you have different concepts of control. So you might just basically have a kind of a clause that addresses that foreign CFC rules also apply. But many of European countries, kind of European Union countries, don't have that. So this is a problem. So this is the first thing. So very good question. And yeah, the answer is not very satisfying, right? So that may absolutely lead to double taxation. Okay, so that is the control concept. Any more question in that regard?
Якщо є питання і, ну, якби важко формулювати англійською, задавайте українською, я буду перекладати.
Okay. If there are no further questions, again, we have plenty of time in the end. So if something comes up in the end, that's also cool. We can also go back and go back to slides that we already discussed. So yeah, whenever you have a question, please don't hesitate to ask. Okay, so this would be control. The second, I have a question here, or? Yeah, you can actually, yes, there's a message. Yes, you can absolutely also write questions. That's also cool. Absolutely, you can do that. Okay, so yeah, low taxation. Yeah, Germany considers countries that have a corporate tax rate of like 25% or less as low tax jurisdictions. Yeah, that's quite a high tax rate. Okay, 25%. We are talking like Scandinavian countries, and pretty much everyone who taxes corporations lower is considered a low tax jurisdiction. This is the big problem. The background is that in Germany, we have a 15% corporate tax rate, but we have also a 15% trade tax. So combined, we would have a tax burden of 30%, give or take, which is, yeah, quite high. But then again, yeah, 25% is not so much less, right? So just consider you have a country that like has a tax of like 24%. And you are subject to a CFC taxation, okay, because of this kind of 1% or 6% tax difference. So that is a big issue, because this the kind of the tax difference in these cases doesn't really basically justify the bureaucracy that applying a complex system like a CFC rule brings with it. So this is a big problem, and this is the main criticism that is pretty much voiced against the German CFC rule, rules that we have this high low tax threshold. Okay, I mean less than 25%. Just to give you a perspective, I think in Ukraine you have like 18%, right? So yeah, low tax.
Yes,
but also the UK 19%. In most cases, the United States. These are not tax havens. These are just regular countries. Okay, so pretty much that's really not what CFC rules actually have in mind. You want to tax you want to address these tax havens, okay, that have a tax level of like 5%, 0, or just a stamp duty, something like that. But this is ridiculous. And yeah, pretty much everyone in the German tax literature, including many voices from the fiscal authorities, say this has to be kind of lower to 50%. But it kind of didn't happen, kind of because of Chancellor Olaf Scholz, then the Minister of Finance, he just didn't want that because it's anti-tax avoidance provision, and he just didn't want to, change something there or make it less strict before the elections. That's basically what this was about. And let's see how things will be in the future. But this creates a lot of problems. I think in Ukraine, the low tax threshold is kind of like 13%, something like that. So 18 is the regular rate, and yeah.
No, it depends.
Okay, it depends. Yes, okay.
It depends. We have a list of countries.
Okay, you have this. Okay, you have this kind
so
of.
Each year, the actual cabinet of ministers, our government, it's kind of introduced list of countries, and it's not only the tax rate. It's also form of ownership, and we have list of countries and list of ownerships which are related to particular countries, which kind of under Beobachtung.
That's actually a not too uncommon approach. It's called the designated jurisdiction approach. So you can absolutely take that approach.
This German taxation was really an issue for my clients at least, because we even had a lawsuit case. And the client was tried to claim that it's not the same like income taxation in Ukraine and in Germany, and he tried to prove that it's not fair to add two taxes together, that straight tax is not exactly corporate income tax. And if you look at corporate income tax, it's 15%, and in Ukraine it's 18%. So
yes,
higher. Well, of course, it leading to nowhere.
yeah. Actually, I will come to that one when we talk about the tax credit. So that is actually, trade tax is generally a problem. German trade tax, somewhat exotic. No one else has that, and it's always good not to be completely exotic when it comes to taxes. But that's a lesson that Germany still has to learn. Let's put it like that. Okay, low taxation. Any further questions in that regard? Okay, then let's move forward. passive income, okay? So basically, what the anti-tax avoidance directive suggests is that it basically includes a list of harmful income, of income that is considered as kind of flexible income that can easily be shifted to low tax jurisdictions. So they basically say what the harmful income is, okay? That's what the Data says. And the German lawmaker, however, took a completely different approach. What the German lawmaker did back in 1972 is he said, okay, we will define the sources of income that are okay. We will define the sources of income that are basically active, okay? Active income is basically considered as okay, and we will positively define what is okay, like having a factory, like having a farm somewhere, that kind of stuff, okay? What was considered as active or as regular stuff in 1972. There were not too many changes to that catalog, actually, and the German lawmaker even considered or even decided to stick to that active income catalog even after the Implementation Act. So basically what we do is still we positively define the income that is not harmful, and everything else is harmful. So a question for you, what do you think? What is the downside? What is the problem of that approach? If you define active income in 1972, which is like 50 years ago, and then stick to that and say, okay, that's cool stuff. That's the stuff that is not harmful, and everything else is like bad. It needs to be taxed under the CFC rules. What might be a problem there?
All new businesses are out.
Yes, that's basically the thing. I mean, in 1972, there were no YouTubers, no influencers, there were no electric cars, there were no IT services. So basically, the lawmakers simply didn't think of that because it wasn't there. So if you have that kind of a system, then everything that is new is basically subject to CFC taxation. And that is not a smart move for a country that considers itself one of the leading technology leaders in the world. So that is pretty much nonsense, okay? But that's what we have to deal with. So everything that is new is basically passive unless the German lawmaker adapts this catalog, this active income catalog, which he doesn't. Okay, so yeah. Tatiana, you yeah?
Yeah, because I think it takes years to change that catalog.
If at all, yeah, okay. So the German lawmaker pretty much didn't do that for 50 years. It was only due to the Data.
There's a big difference between German law and Ukrainian law, and we complain about that in Ukrainian law all the time, that it's too much flexible and changing very often and very fast, which is not the case in Germany. In Germany, it takes like a couple of years just to discuss the idea and then to implement the idea. So basically, it will like 5 years at least to make some steps.
Absolutely. I think that there should be some solid middle ground here. Both is probably not great, okay? Changing the system too fast is somewhat problematic because this is also obviously from an economic perspective leads to transaction costs and stuff, and that should not be underestimated. That's a lot of bureaucracy. But then again, never really changing anything, especially with regards to these kinds of sophisticated provisions, that's also not a great approach. So there should be some middle ground, right? Okay, so I will not go too much into detail what this active income catalog is about because it's just too complicated. It's more or less in line with the anti-tax avoidance directive. So you find that catalog basically in English. So so that is basically the concept, okay? But I'm obviously happy to answer any questions if there are any particular questions regarding the active income catalog in Germany. So, okay, no further questions. Then, let's move on and have a look.
May I ask you a question?
Absolutely.
I have a bad internet connection, but maybe it's not rely exactly on some taxation, but like in just my interest, maybe you have heard that in Ukraine almost everyone is like, private enterprise. So everyone want to become a businessman, and we have some trend like, to open some coffee shops. It's easy to make it bureaucracy in Ukraine, and like to open your like some tax line to pay it and to make your business. Is it so easy in Germany, like to begin to be some like private enterprise, or is it more strict system than in Ukraine?
Short answer, no, it's not easy. There's actually a lot of bureaucracy. Also, tax compliance is not that easy, actually. Yeah, I think at the beginning you can have some kind of cash-based accounting, but that at some point, if your turnover is somewhat higher, then you will have to set up a German tax balance, which is quite bureaucratic. So tax compliance will be an issue. Also, generally there are legal prerequisites. You have to register for the trade register and that kind of stuff. So yes, there is definitely more bureaucracy in Germany, and we are not the most business-friendly country, I have to tell you. So this is really everything is pretty much regulated, but you also have to consider what kind of people you have here. Maybe you have a taxi driver who came to Germany basically and doesn't really speak German too well, and he's confronted with all that bureaucracy. Okay, he certainly knows how to drive a taxi and kind of pass that test. You also need a test for that. You can't just drive a taxi in Germany. This is also a relatively strict tax, and then the tax authorities come around and ask him stuff, and so no, it's not that easy. I mean, I'm not saying it's impossible, but when it comes to ease of doing business, Germany is probably not the country you might take as an example. There are just better examples, but yeah. So we would be glad actually if we had this wave of entrepreneurs, but we kind of don't have that. That's also a problem I see with my students. Actually, most ones just want to be employed somewhere, and really there's this kind of entrepreneurship that's not really what many people really want, which is a bit of a problem regarding innovation and stuff and dynamics of economic development, because really this kind of mindset, that basically you want to be employed somewhere. You need some entrepreneurs, right? But then again, the whole German system kind of makes that a rational choice, because if you are employed somewhere, wages are fine. We have minimum wages. Health insurance is pretty good. You have like 30 days of holiday, that kind of stuff. So there are good reasons not to be an entrepreneur under these circumstances, because it's just for many students it's really just more attractive to be just employed, so just works at some company. And I struggle to kind of find students who actually want to be a self-employed tax consultant, which basically is what I do. That's what I train students for. And actually many people don't want that, because kind of they're just maybe more attractive alternatives. So very good question. Thank you for that. And
maybe they just want to avoid headache,
Yeah. It's also possible. Yes.
Yeah, and what Alexandra started asking, actually, it's led to the next question. I know the answer, but probably my colleagues don't know. In Ukraine, we have a simplified taxation for those entrepreneurs. If it's a small entrepreneur, and I mean, it's not really small in terms of German, because it's in German, it will be definitely not small, but in Ukraine, it's still considered like a small, and they are subject of simplified taxation. It's only one tax, and it's really very small rate. Well, now it's a different story. It's 2%, but even before war, it was like 3 and 5% from the turnover, and I don't think it exists in Germany. In Germany, it's a subject of regular income tax and trade tax, right?
Yes, absolutely. Okay, so you have like for trade tax purposes, you have kind of a exemption of like 24,500 euros. That's what you have, but above that, you're subject to trade tax. When it comes to VAT, we have this kind of small entrepreneur regulation, but that also kind of, if you have a turnover of like more than 50,000, give or take in 1 year, then you're pretty much out of that one. And then you also are subject to regular VAT. And when it comes to income taxation, there are basically no favorable rules. At some point, you still can have this basically tax-based accounting, but that also ends at some point. So yeah, pretty much all entrepreneurs in Germany are unable to do their own taxes. They all need a tax consultant. So this is also something that says a lot about the bureaucracy. So maybe we could learn a lot from countries like Ukraine or Georgia in that regard. So yeah.
I'm sorry, it was really interesting topic that you mentioned about tax like advisor, because I know I know by myself lots of guy who has their own business, and they are really became good in tax system, and they can even be an advisor of their own accountant to check if everything is okay. So my question is it just our behavior to dive into such systems knowledge and to control your finance, your financial flows, or is it just because our system is simpler than in Germany? Why is it so comfortable for us to dive into the world of finance and to become an entrepreneur?
Yeah, probably it's actually the one thing is that it's actually simpler. That may very well be a reason. Yeah, but maybe Tatiana may have some ideas on that.
I can compare two systems. So I'm already almost a year in Germany, and yes, I do consulting, but I give up tax consulting. I even never, it's never even crossed my mind to do tax consulting in Germany. So I do the other consulting, and it's kind of, yes, my business, but I have a tax advisor. In Ukraine, even you have a tax advisor. I have a tax advisor in Germany. I just opened a German tax law and I closed it. It's like, no way. And I just gave all the rights to my tax advisor. He's my representative. He does all my taxes, all communications with Finanzamt, everything. I just... even don't want to look crazy.
It definitely is, and it also what is worth considering is it's actually this profession of a tax consultant. I mean, this is really, I took this exam. This cost me a year of my life. I would rather write my PhD again or apply for a professorship or you name it. But I would certainly not want to pass that exam again. This is, and you have to do that. And then at some point, you are allowed to do tax consultancy. So actually, as a university teacher, you may at some point, if you are you get that for free. But these are very few exceptions. Typically, you really need to pass that exam, and really, it's very complicated. So and yeah, there's a lot of money involved, obviously. So this is good business, tax consultancy. But then again, why is it that good of a business? Because there is so much bureaucracy. So if you ask me, there are some sources of complexity that are just inevitable. If you're looking at international tax law, if you're looking at corporate taxation, obviously this is complicated because this is complicated stuff. There's a lot of money involved, but there's no good reason why just like a private person, like a university professor, needs a tax consultant. That is something that is really, this is weird. Okay, this is not necessary. But yeah, still, that's basically the German approach. I will come to that somewhat later. So, any further questions or? Cool. I don't see any. Okay, cool. And let's have a look at the legal consequences. Let's come back to the German CFC rules. So basically, yeah. First, you might think, okay, the Germans have this weird CFC rules, but then again, they have a tight net of double tax treaties. So maybe it's not so much of a problem. for example, with regards to the United Kingdom or the US, because there is a tax treaty in place, a double tax treaty. So maybe this is not so much of an issue. Yeah, I got bad news there. We have a treaty override. So basically the provisions of the German CFC rules override any provision of double tax treaties. So really the double tax treaty doesn't protect you because the German CFC rules apply anyway. So this is really bad news. And this is an issue we very much have with regards to the United Kingdom now, because yeah, we have a decent double tax treaty, but it doesn't help us there. And the tax rate is like 19%. So these are all basically CFCs there if you have outbound structures. So that is a bit of a problem. So the double tax treaties don't help you. That is, I think, somewhat different pretty much everywhere in the world. It's not in the ATAD. So the Anti-Tax Avoidance Directive does not really, include this treaty override. And I think also in Ukraine, you have that provision. So if something is tax-free under a double tax treaty and some other provisions are met, so that then you are out of this CFC system, right? Yeah, okay, I see. Tatiana nodding. So yeah, that's the better approach. So please just stick to that. Just don't implement this German approach because this just makes things way more difficult. Okay, treaty override. Bad news. Further questions here. So if you thought that was weird, let's have a look at this one. Okay, what we don't have in Germany is a demarcation between limited tax liability and CFC taxation. And that may lead to the ridiculous situation that in some structures, Germany is actually considered as a low tax country from a German CFC perspective. Let's have a look at this one. We have a UK Limited. So this is basically a third country corporation that holds German real estate. So that's basically how this works. Yeah, you don't really see too much tax planning here. This is just a regular, basically structure. And why do you set up these structures? Because in case you don't have a permanent establishment in Germany, no trade tax is levied. So basically Germany is taxing rental income in these structures. So this guy is UK, and we are Germany. So basically, Germany taxes this under the limited tax liability regime as a German source with 15% corporate tax, but without trade tax. So, and then we are looking at basically CFC taxation, because I have to add that's one. We have a German shareholder here, say he holds 100%. So now the German CFC rules come into play and say, okay, in the UK, you have like 19% taxation. And okay, then we have rental income. And there is no demarcation. There's no kind of clause that says that the CFC rules are kind of limited to foreign sources of income, but German sources of income are actually included. Yeah, there is a clause within the CFC rules that would say that if a foreign source of rental income is subject to double tax treaty kind of exemptions, then that would be cool. But Germany itself is obviously not excluded from German taxation due to a double tax treaty because it's Germany. Okay, so basically what we have here is we would first tax that under the German limited tax liability regime. Basically, this is an item under Section 49, German Income Tax Act. And then we would tax that again under the German CFC rules and say, okay, we have basically a CFC, and this is CFC income, so we'll tax that again. And the one thing you get then is a tax credit. So basically, you credit the German taxes levied under this limited tax liability regime. You credit these taxes against pretty much the CFC taxation. But look at this, how much bureaucracy you have here. This is completely ridiculous. So the next take-home message, please include a kind of a demarcation between the CFC regime and your domestic income, which is easy to implement. Just say we limited this to foreign sources of income. This is really, it's a no-brainer, okay? But for whatever reasons, the German lawmaker didn't really see a need to do this. And in practice, what we do is basically we don't really use third country vehicles here. So what we would see here in practice is a Luxembourg SARL, Société avec responsabilité limitée, a French kind of limited, something like that. Yeah, then we have this Cadbury protection, and then that would mostly work. But this is weird, right? But yeah. This complexity is basically a big challenge for German tax practitioners. There is a reason why we basically write these huge bills to our clients. Okay. Yeah. Any questions regarding this one?
I have some questions. What is the level of tax evasion in Germany? And
please.
And how Germany treats the concept of aggressive tax planning?
Well, first, regarding the level of taxation, we would have to basically have a look at what we are talking about. If you're talking about a corporation, like a German GmbH, which is kind of limited, then we would have 15% corporate tax, and typically we would have 15%, give or take, trade tax. Trade tax is kind of a tax that depends on the tax multiplier levied by the community where the company is basically working. So that is kind of flexible. But normally for a corporation, for withheld profits of a corporation, the tax rate would be 30%. More or less, okay? And for an individual, we would have like something like that. We would really have a marginal tax rate. This is the income, and we would have a marginal tax rate that is kind of progressive. So you would have something like that. So we would have basically the first about 10,000 euros would be basically not tax-free, but they would not be subject to taxation. Because this is basically the existence minimum, so we don't tax that 10,000 euro. So then every further euro is taxed somewhat higher. So that starts as like 18%, and the next one 90%. So that is kind of the idea of this progressive system. And at about 60%, you end up in this flat rate zone. So then you have 42%. And if you end up like making like 260,000 euros, if you're in the lucky position to make like 260,000 euros, then you would pay 45%. And then we would also have the so-called solidarity surcharge. That is kind of, I think you have something similar right now, kind of this additional war tax, right? Like there's something levied. That's a bit of a similar system. We introduced that after German reunification. That's 3.5% of the tax burden. So basically you're paying taxes for the privilege to pay taxes, but that is kind of the context. But German unification is like 30 years ago. So yeah, that's why this may be kind of at some point abolished. But basically you end up, if you're really making a lot of money, you're paying 45%, and including this solidarity surcharge, that would be like 48, give or take. Okay. And really one thing is really to consider is that this 42% zone, like where you're paying a marginal tax rate of 42%, that kind of starts at like 60,000 euro, which considering German prices is actually, it's not a bad salary, but it's kind of something that's what employees get. And if you want to live in a city like Frankfurt or so, this is not really that you are really a big earner there, okay? That's enough, but it's really considering these prices, not so much. So really relatively early, you have these 42%. And this is also a bit of a problem, okay? Because relatively early, you have relatively high taxes. Okay, that would be basically corporate income tax, these 30%, and then individual income tax, this progressive rate. Is that more or less clear, or are there any further questions in that regard?
Yes, but Oksana asked about tax evasion level. Tax evasion.
Yes, that would be the second question, indeed. Yeah, we know that concept. It's basically an international concept. So you have, or let's put it like that. You have aggressive tax planning. That is basically what this base erosion and profit shifting stuff is around. And then you have really a criminal offense with this tax evasion. And yes, we have that. And yes, it is very much enforced. Okay, so that is something that we definitely know. We don't know that concept, and this is basically the two different things. The one is tax planning. We have plenty of provisions against tax planning, but that is within law. And then if you just kind of shift money to if you just take a kind of bag and then physically carry money to Switzerland, something like that, or if you just don't declare sources of income, then indeed tax evasion is something that is an issue, and so it is a criminal offense. Okay, definitely. Mm-hmm.
Thank you. It's a very bad signal in Ukraine.
Yeah. I'm not gonna lie to you. I mean, there's kind of this idea that okay, tax evasion, this is not a real crime. You really find that in Germany, and I'm not happy about that, I have to say. So if some contractor comes to your home and kind of repairs stuff, and then in the end, what is he gonna ask? He's gonna ask, do you need a bill? Because he thinks, yeah, kind of you're a private person, you can't really deduct input VAT. So why would you kind of want a bill? you can just basically do that without taxes and then kind of split the profit. That's the idea. And I really hate that, I have to say, because this is tax evasion. Okay, I'm a public servant, but this is common. This is pretty much always happens. But as a tax professor, I have a good answer. I say, yes, I need a bill for section 35A of the German income tax code, because I actually can deduct some of that for income tax purposes. It's just that no one knows it. Okay, but actually I can. If I have a bill, I can actually make use of that. And then they say, okay, that guy knows his stuff. Maybe he works for the fiscal authorities, and then they leave me alone. And boy, you get your bill real fast. Okay, and you can pay by credit card. Then everything is smooth. Okay, but this is a problem. It's pretty much a problem everywhere in the world, and in Germany in particular, it's a problem because it's about a lot of money. Okay, this is really, I mean, especially VAT and stuff, and yeah, we also have that problem. But the German fiscal authorities are relatively strict there. Okay. So and even very popular, prominent people go to jail for that. Maybe you know, probably not. Uli Hoeneß, that was a football manager, very famous football player. Basically, everyone loved him. And then, yeah, there was this tax evasion case, and then he ended up in prison. Okay, because there are no exceptions. So relatively strict, but still, yeah. We have that problem. Okay. Are there any further questions? Cool, then let's move on and let's just have a look at how that works. How basically, if the legal prerequisites are met, how basically the income is shifted to the shareholder, how this add back takes place. And therefore we have to differentiate between two steps. First, we have to determine the income of the foreign corporation, and then we have to think about how this add back, how this attribution of the income actually takes place. Okay, that is basically what we have to think about. And first we have to ask ourselves, how is the CFC income at the level of the foreign corporation computed? And there's also bad news here. You have to do that in accordance with German tax law. So say you have a UK CFC, obviously in the UK, they want you to set up kind of a tax accounting under UK standards. And then the Germans would say, okay, but you're also a CFC, but what you also want you to have is basically want you to set up a German tax balance for German CFC purposes. So we really expect the foreign corporation to set up a German tax balance. So we have to do that after the Anti-Tax Avoidance Implementation Act on an actual accounting basis. Earlier, we had the option to do that on a cash-based, via cash-based accounting, but that was changed, and I can tell you why. There were some tax planning approaches. So what you would have done before the Anti-Tax Avoidance Implementation Act is this: you would have a foreign CFC, and you would use tax-based, cash-based accounting. And if you had kind of an interest-bearing bond, then you would say maybe all the interest will be kind of due in year 01. Okay, you can do that with cash-based accounting. It's basically about when the influx of money takes place, and basically the idea was that would be in year 01, and then before the end of the year, we would sell the corporation to a non-German resident. And the problem is that the German CFC rules expect you to participate in the corporation at the end of the fiscal year of the corporation with more than 50%. So if you do that in the last year, and then you sell the corporation before the end of the year, say in October or November, then there is no CFC taxation, okay? Because you need this participation at the end of the year. And so basically what was done was, okay, you get all the stuff to cash-based accounting in the last year, and then basically you sell the corporation, and then there is no CFC taxation, and then so you kind of avoided these German CFC rules. That is what was done, and that is why now it was decided that you really have to set up a tax balance. You have accrual-based accounting basis. And under this system, basically, this tax planning approach doesn't work anymore, because you just simply can't have all your income in the last year, because basically there's in an accrual accounting basis, you would really have to have interests in every given year, not in the last year. So that is why this approach is not possible anymore. But still, it's a lot of bureaucracy, okay? Because you have to do that parallelly to your tax obligations in the respective foreign jurisdiction. So a lot of bureaucracy. I say that quite a lot, okay, but there is a reason for that, because it's actually quite complicated. Okay, any questions in that regard? Then, okay, then the question of how is the add-back amount is basically determined. There's another issue, that we have all kinds of anti-tax avoidance provisions. For example, we have the so-called interest barrier, which is a thin capitalization rule. You also have that in Ukraine. So this is basically what we have. And under the old system, these provisions were excluded when computing the income of a CFC, because the idea was just that it's too complicated to apply these rules within another anti-tax avoidance rule. So that was basically the old idea, but that was deleted with the anti-tax avoidance directive implementation law. So now we have to think, when calculating CFC income, we have to think about all the other anti-tax avoidance provisions. So you have to think, do I have to apply the thin capitalization rules when computing the CFC income of this corporation? So there is no clear demarcation anymore between these German anti-tax avoidance rules. And that's also a take-home message. Just have a clear demarcation between the scope of anti-tax avoidance provisions. We don't have that, and it creates a lot of problems, because if there is an overlap, then there's the danger of an overtaxation, there's unnecessary bureaucracy. So a clear demarcation between anti-tax avoidance provision is very much beneficial. Okay, so that would be the determination of the income. And then basically we would have the option of loss carry forwards at the level of the CFC. I think you have that too in Ukraine. No less loss carrybacks. That is kind of ATAT stuff. We had that before, but the ATAT does preclude that. So now we have only loss carry forwards, pretty much as you have in Ukraine. So that is pretty much not new for you, right? So, and then there's another thing, and I really need to address this one. In the old system, we had kind of a special system for downstream corporations. So if you are kind of the shareholder here in Germany, and you have like 2 foreign corporations that are both CFCs, under the old system, what we would have done is we would have collected all the income of these downstream companies at the level of the parental foreign companies. So that would all have been collected here, and then we would have had this CFC add back, okay? And the advantage of that was that actually if you had losses at that level and profits at that level, you can kind of set these losses against profits at that level. So pretty much this is like a tax group. If you're familiar, I think, do you have tax group for corporate tax purposes in Ukraine? Do you have that Organschaft? Okay, yeah, that would basically mean that the whole the whole group is taxed like one entity. So we kind of had that, but this is not in line with the anti-tax avoidance directive. So
kind of have it too, but it's kind of it's not exactly like group taxation. So it's a really complicated story and a lot of bureaucracy. Like each member of the group is supposed to submit a tax certificate from the authority of jurisdiction that was taxed, and it takes like years to put everything together.
Okay, yeah, pretty much like in Germany. Okay, so same thing here, super complicated. We have it, but it's not great. Okay, but yeah, basically, it's even not worth talking about that because this is the past, and now what we have is kind of we directly tax every downstream corporation. So we look at this and say, is there a direct or indirect control? And the CFC rules are directly applied to all downstream corporations, which has the disadvantage that you actually can't set of losses against gains at that level. That is not possible anymore. Okay, so if you have losses here, you can just carry them forward, and if you have future profits here, that's cool, but you can't really use that in Germany. So that is the new system, and actually the ATAT actually demands that. And there's another thing, the ATAT has the concept of control in the sense of a unlimited taxpayer controls a corporation together with related parties. I think what you have in Ukraine, Tatiana, you can correct me if I'm not correct, but what you have is basically the old German system, which is domestic control, right? So Ukrainian residents kind of combined shares of Ukrainian residents would need to hold more than 50%. Is that more or less correct? Yeah. This is the old German system. We had that until last year, but that is not in line with ATAT. So what you would need to do to bring your CFC rules in line with ATAT is actually implement a control concept that would say, okay, Ukrainian residents together with related parties, even if they are not kind of Ukrainian residents. And this actually is the superior system, and I can tell you why. Because again, there are tax planning approaches. Let's just have a look at this one. Okay, let's say we have a Ukrainian, kind of a limited. How would you call that? Like a limited company in Ukraine. Some kind of let's just call it a limited, but Ukraine. Okay, so that is Ukraine. And then you have a CFC, and let's say you hold like 49%, and then you have this CFC. So, okay, under the old system, which we also had in Germany, this was possible. Let's say we have a Georgian limited. This is Georgia, okay. Okay, and these ones hold the other 51%. So this was the old system. And under the old system, you would say, okay, we don't really have domestic control because domestic shareholders only hold 49%. And this Georgian guy here, he holds 59%, but he's not domestic, right? He's a foreign tax resident. So in that system, at least from a German perspective, under the old system of domestic control, you would have said, okay, this is no control because German shareholders only hold 49%. I don't know how you would do that in Ukraine, but probably you couldn't really say that this Georgian guy here is basically a domestic shareholder because he isn't, okay? So that is the problem with this concept of domestic control. And under the new system, we would say, okay, if you have like the ATAT approach, you would say, okay, this is a Ukrainian shareholder, 49%, but then we have related party. And the related party is also kind of has a 51% share. So we would only add back 49% of the income, but the CFC rules would apply because we would say these are related, okay? That is kind of the new approach of the ATAT, and this is very much superior. So in that regard, actually, pretty much everyone is happy that we have except for some law firms who set up these structures. But yeah, that is basically the new approach. So under the new approach, under the ATAT approach, we would say related parties, so basically control and CFC taxation. Under the domestic control system, you would not really say this is domestic control. Or maybe I'm wrong there about Ukraine. What would you say, Tatiana? Is that control under the current Ukrainian system? You would have to switch off the...
Yeah, it's much more complicated, actually.
Okay, maybe it's even more complicated, but...
It's even more complicated, and it's changed recently, like a couple years ago, it became very strict as control of the final beneficiary.
Okay, so maybe you have that covered, but still, just to give you the main idea, so that this kind of...
Yeah, but I mean, it's new concept, and it's like, I mean, people in academia, they're not aware about that concept. It's like all the practitioners started bumping into the situation. And it's just before war, so it's like a couple of years. So it's I know that concept. It's really complicated in Ukraine. It's a lot of control issues because it causes actually a lot of conflicts because we don't have appropriate databases. And what happened in Ukraine, again, I don't know how it works in Germany, probably even more complicated with all this data shoots and other stuff.
Yes, that's always an educated guess, that it was more complicated.
Yeah, but in Ukraine, what happened, like, okay, I use one base and I have to pay for it. So I have subscription and I can prove that everything what I did, it was correct. But then tax authority comes and they use a different database. And it's different results. Yeah. What happened at the end of the day? We start fighting with each other in the court. And it involves forensic accountants. And it takes like 5 years to solve the case. And all these recent cases, they were not in favor of tax authorities. They were in favor of business.
Yeah, at least that is good news. Okay,
yeah.
Cool. So, yeah, that would be the determination of the add-back amount. Any further questions regarding this specific aspect? Cool, then let's go on. Yeah, technique of add-back of income of the German shareholder of the CFC. So how does that work? Basically, what the shareholder gets is a kind of fictitious dividend. He doesn't really get a dividend because the profits are typically withheld, okay? But he gets a notional dividend. So we basically, he's taxed as if he had pretty much received a dividend from the corporation. So this is a fictitious dividend that is basically subject to taxation here. And then again, we have relatively favorable rules for dividends, but obviously those ones are excluded because we actually want to tax this fictitious dividend. So no kind of tax exemption here, and basically this fictitious dividend is taxed. Okay, so that is basically what happens. And then there's one weird thing that under the old system, the CFC taxation would take place in the year after the fiscal year of the foreign corporation. And under the new system, it's basically the end of the same year. This leads to the somewhat strange situation that in 2022, you have two CFC taxations. So if you have a foreign corporation in Germany, you will be taxed under the old system for 2021. And because you kind of have this change in the system, you will also be taxed for 2022. So, but that's cool. That's just because we changed the system. You have to do that somehow, right? But 2022 will be a somewhat expensive year for many German shareholders, okay? Because basically you're taxed twice under these CFC rules.
We taxed in the same year.
Pardon?
We taxed in the same year.
Yeah, good, because this is kind of what the ATAT requires. So the old approach was just not in line with ATAT. So this is really not the fault of the lawmaker. That's ATAT, okay? So you can just keep that. That's cool, and still join the European Union. No change required there. But we had to change that, and yeah, that's the result. But again, that is cool. That is not the fault of the German lawmaker here. It's just kind of a transitional period. I think you have something like that too, right? You have also a transitional period like until 2024, I think. Yes, that's also a good idea. Okay, okay. So that is the technique of add back. yeah, and then let's talk about some exemptions here to the German CFC rules. And yeah, the first one, we can keep that relatively short. We have a de minimis limit, so a kind of a exemption for marginal cases if there is the passive income does not exceed 80,000 euros. So that is something that was included in 1972, and it wasn't even a kind of changed due to inflation since then. So not even that. So 80,000, this is ridiculous. So just, you don't get this de minimis limit. I think in Ukraine you have a somewhat higher limit, right? I think at 2 million or something like that. But 80,000, that's not any good. So that is, you really have to consider inflation as a lawmaker, okay? I mean, 50 years ago, that was probably a lot of money, like 40,000 Deutschmarks, that was real money, okay? But today, 80,000, yeah, just forget about this one. What you actually get maybe at some point is this one here, the motive test. So there was this European Court of Justice category Schwab's decision that basically said, okay, you need to give at least European Union, European Economic Area corporations the chance to prove that they're doing something useful, yeah, very simply spoken. So that they have a kind of an economic activity in the respective country, they have qualified personnel, and that at least gives you some option to avoid the CFC rules, at least in European Union and European Economic Area cases. There were some amendments here. Now a substantial economic activity is required after the entered implementation law. But still, this is the best thing you can get. But the bad news is right now, this is only for EU and European Economic Area corporations, which is a problem. Also, pretty much everyone in the tax literature, including me, demands that this be a kind of extended to third country corporations. But right now, I don't really see that coming. So that is really a problem. I mean, this is not only a problem for Ukraine. This is a problem for like United States, United Kingdom, Switzerland, you name it, okay? Pretty much everyone who is not in the European Union or the European Economic Area just does not get this exemption. So you really have to check, is there any passive income, low taxation, control? So that is really a problem. And we have huge issues with that regarding the United Kingdom, because we don't get that anymore. Before the Brexit, we kind of would just say, okay, yeah, they have some people there. If I call there, someone kind of takes the call, and then there is kind of some economic activity, and then we are good. But we don't have that anymore. So this is a real big problem. And actually, the AirTag would allow to extend this category clause, this motive test, to third countries. We could actually do that. And some countries did, but Germany, not so much. So we really are stuck with this one. And this is actually a bit of a problem. I think in Ukraine, you also have a kind of a motive test, which is in your CFC rules, which is also good and required from an ETA perspective. But that is actually quite a challenge, I would say, from a German perspective, with regards to any country that is not in the EU. Okay, this is really a challenge. You always have to check for CFC rules, because this motive test is limited to European Economic Area cases. Okay, so the motive test. Any questions regarding this one? Okay, so then some brief words regarding the treatment of dividends and share sales, and some tax planning ideas, and then we are through with the presentation, and I can gladly answer your questions. But some words I would really like to say about that issue, because it's also something that is quite crucial for CFC rules. The idea of a CFC rule is basically that profits are withheld, okay? Because only if you withhold profits, they're actually shielded from German taxation or the taxation of any other country in that regard. So the idea is basically you have like an income of 1 million. This is passive. This is low taxed. And kind of this is withheld, and then the CFC rules apply. And under the CFC rules, we would say, okay, this is a low tax country, this is passive income, we also have control. So we are taxing these 1 million euros as a fictitious dividend. That's basically what CFC rules do. But then we have a problem. What if this limited would at some point actually decide to distribute profits? So we distribute this million as an actual dividend. So if we tax that again, then we have a double taxation because we already taxed this income as a fictitious dividend, okay, under the CFC rules. And if there is an actual profit distribution and we tax that again, then we have a double taxation. So that is why CFC rules should consider actual dividends, and there should be kind of a tax exemption or something for that, because otherwise you have this double taxation. Yeah, in Germany we had that before. It was somewhat changed due to the ATAT, but more or less we have a kind of a tax exemption here. This is very simplified, but okay, we kind of considered that. So this dividend would be typically not subject to this taxation because we already taxed this income as a fictitious dividend. So the actual dividend is then more or less not subject to taxation. And that is a very useful feature. That should also be the case for share sales, because there you have the same profit problem. So that has to be somehow considered. The ATAT actually says, okay, we do it like that. We just apply the CFC rules for withheld profits. So if profits are distributed, then basically you don't have to do any CFC taxation. But if you have an approach that kind of says we don't care about if the profits are distributed or not, then you need a provision like that, just to avoid double taxation. Okay, treatment of dividends and share sales. Any questions regarding this specific topic? Okay, there's nothing in the chat. So let's go on then. And the last thing is tax credit. And there I come back to what you said, Tatiana. This is the big issue. Well, first of all, yes, you get a tax credit. Okay, let's say we have the United Kingdom. Okay, you have these 9% taxes. And you have a German shareholder, let's say like a corporation, a German GmbH, a kind of a limited, and we have this foreign limited. Okay, and then we have we have basically CFC income, and that is taxed in the UK. So we have 90% CFC. It's basically, this is regular UK corporate tax, okay? And then we have this CFC taxation in Germany, and there we have 50% corporate tax. Oh God, I don't know what's wrong there with Zoom, but my paintings are always horrible. That's more like modern art, but yeah. Okay, that's 50% corporate tax, and then we would have about 50% trade tax. So then we have this issue that we actually have a tax credit, but in Germany you can only credit taxes against credits of the same of taxes of the same kind. So we can credit British corporate tax against German corporate tax, but only to the point where we actually have German corporate tax, which is 15%. So there's 4% UK taxation that we can't really use in Germany. And the problem is that we still have these 50% trade tax. No one else really has trade tax. This is a German thing. And so basically what you end up paying is 50%, okay, you get a trade credit. So basically you pay the corporate tax here in the United Kingdom, like 90%, and 15% German trade tax on tops. And we have kind of this is called an Anrechnungsüberhang. I don't know, Tatiana, what that is in Ukraine or even in English. It's probably a German thing. So basically, to rephrase it, it's basically you have foreign taxes that you can't credit against anything because basically you have this limit of 15%. And German trade tax is not good for any tax credit. So that's an issue. So typically, if you end up in these structures, you end up paying more than a domestic corporation would pay, which is also somewhat questionable from a European law perspective, even considering that the United Kingdom is not part of the European Union, because you have this freedom of capital, and that can also lead to some issues, even with regards to third countries. So also not a great idea. And actually, there were discussions to allow for a tax credit against trade tax. That was actually in previous drafts of the German anti-tax avoidance implementation law, but then it wasn't implemented. So we are still having this problem. So tax credit, yes, we have it, but not for trade tax. And so, yeah, we basically end up paying more. So takeaway message here, just don't have exotic stuff like German trade tax. That's not good. If you just stick to normal stuff that is internationally just normal, like corporate tax, that's cool. But all the special stuff we have in Germany, that all just leads to problems, yeah. And there's really no good. There's really no good reason why we wouldn't have just a corporate tax rate of 25% and then that's it. You know? But yeah, I think I don't have to tell that to you. I probably should tell that to Olaf Scholz, but he's not really listening. Okay, so tax credit. Any questions in that regard? Yeah, actually, I hold lectures in the German Ministry of Finance, but still, he's kind of not attending. So, yeah, what can I do there? So then some areas of particular concern. Yeah, this is something, okay, if you thought right now that this is kind of weird and not the greatest system, then yeah, this comes on top. We have an extended taxation for passive income of an investment nature, which is basically interest-bearing bonds, that kind of stuff. So if you have sources of passive income that are really, really bad, like bonds, that kind of stuff, then the German CFC rules apply even without control. So even a kind of a free float interest would be sufficient to trigger the German CFC rules. So just to give you an idea what that would mean, let's just say we have a corporation. This is basically the German shareholder. He has a UK limited, and then we have maybe a limited in, let's say, in Kenya. And then we have a limited, or that would be probably more like a ZARL in the Democratic Republic of Congo, okay? So that's what you have, and the interest is like 1%. And unfortunately, these guys here, they hold interest-bearing bonds, yeah? So what you're supposed to do, I'm not kidding here, what you're supposed to do is to give these guys a call and say, hello, presumably you should do that in French, because otherwise no one would be understanding you. So you will ask them, yeah, here's the thing. We have this extended CFC taxation in Germany, so control doesn't matter, and you have passive income. You're also low taxed because I have kind of a tax rate of like 15%. So basically this income is subject to German CFC taxation. So what you would ask you kindly is to set up a German tax balance, please. Je vous en prie, please, just set up a German tax balance, because otherwise, actually, this is a criminal offense if you don't do that, okay? So this is, I mean, this is ridiculous. And the only reason why this works is because the German fiscal authorities just don't know about this, or they ignore it. It is not enforceable. And this is also a constitutional problem. This is also discussed in the German tax literature, that there's an enforcement deficit, because like 95% of the cases are never discovered. But this is horrible. I mean, what if you actually want to pay your taxes? But if you give these guys a call, they will never come up with a German tax balance. They will never happen, okay? So this is, oh my God. So this should be abolished. But yeah, again, the opportunity for that was actually the anti-tax avoidance implementation law, where you could absolutely have done that. And the anti-tax avoidance directive doesn't provide for that, but it's stricter, so you can do that, but you don't have to, okay? So you don't have to do that kind of stuff if you join the European Union. So you can keep cool, that's cool. You don't have to do that. And I wouldn't recommend it, okay? This is just not smart. Okay. Yeah, any questions regarding this one? You're looking horrified. Yeah, but rightly so. Rightly so, because it's really, I mean, just imagine you are this guy, okay? And you just, yeah, I mean, what can you do? I mean, these guys bought these shares. You don't really have a say in that, okay? You didn't choose that. So just sell your shares, because this is way too dangerous. That would be what I would say as a tax consultant. You can't just do that. You need to sell this, okay? Okay, yeah. If there are no further questions in that regard, let's come to the next one. Okay, and now we go to the concept of the areas of particular concern. And then we have one problem that basically we have said that control requires German tax residents to participate together with basically with related parties. But if you seem to act in concerted practice, then pretty much every structure can be deemed as kind of related parties controlling a corporation. So basically, if this is the structure, you have a German shareholder like 40%, and you have a French shareholder like 40%, and they are not really related, but in the view of the fiscal authorities, they kind of act in a harmonized manner, then that might already be enough to say, okay, this is concerted practice, so we have control and we apply the German CFC rules. So this is something that is also not included in the ATAD, that is kind of on the top German legislation, and that also basically creates a lot of problems. And what makes things worse is that this concerted practice is rebuttedly presumed in case of the use of partnerships. Let's have a look at this one. You have a partnership, and this is a very common joint venture structure, okay? You have this French corporation, you have the French SARL, and then you have a foreign corporation here at like 20% taxation in a third country. And these are not related. They just set up basically a joint venture vehicle. This is very common, yeah? This is what we do, right? If you want to set up a joint venture. And now there's this idea that if you use a partnership, be it a German or foreign partnership, then concerted practice is rebuttedly presumed. So basically the idea is that, yeah, okay, you use a partnership, so you are related parties. So you simply can't do that anymore. What you could do is you set up a hybrid vehicle in some tax haven that is a corporation from a German perspective, but basically a partnership from the perspective of the foreign jurisdiction. Yeah, that is what you could do, and then you kind of are out of that. But what kind of nonsense is that? Okay, because this is really not a tax planning approach. This is just you want to do some joint venture stuff. Okay, this is really dangerous. So before setting up something like that, you really need some serious tax advice here in Germany, because yeah, otherwise you can do that. And this is also not in the ATAD. This is also German stuff, not recommended for copying, really. Actually, if you want to look at a German style good CFC legislation or generally a tax system, the place to look for that is Austria. So they pretty much did that way better than we did. Okay, are there any questions regarding this specific structure? Okay, and then the last example. Okay, I kind of got the time very much wrong, but yeah, I guess there's this one thing. We have this control concept that also includes liquidation proceeds. This is also not in the Anti-Tax Avoidance Directive. It's German stuff. And look at this one. We have two different CFC rules. We have the regular CFC rules, and then we have a CFC taxation specifically for foundations. So if you look at this one, we have a founder of a foundation in a third country, and then we have a beneficiary in Germany who has a claim to the liquidation proceeds. And then we have a beneficiary who has a claim to the profits of the foundation in another EU country. So what happens now is this. Okay, these ones, that is expected. Okay, they say, okay, this is a claim to the profits. So the regular CFC rules would apply. But in Germany, both CFC rules would apply parallelly, because the Section 15 GFTA, Paragraph 15 Außensteuergesetz, would apply, because they would say, okay, this is a foundation, we have participation in the liquidation proceeds, and the regular CFC rules would also apply, because we would say, yeah, liquidation proceeds, we have that too, and no one really knows how that is solved, okay? There's no demarcation between these rules, and so is there a tax credit? No one knows. So, I mean, that may happen that you are to tax twice, okay? That is kind of to be expected. But being taxed 3 times, 2 times in Germany and another time in another country, that is just stupid, okay? So the German lawmaker maybe thought that there is basically no overlap between these provisions. Although I tell the fiscal authorities every year in the German Ministry of Finance that there is an overlap, but no one really listened. And so that's what happens. So just don't set up a foundation if you're a German tax resident. So you can't do that anymore. So no joint venture vehicles, please, no foundations. That's really the bad news. Okay, any questions regarding this structure? Then, yeah, to conclude, basically, we had this reform. The ATAT is more or less okay. The problem is not with the directive. So if you just implement the directive, that's cool. If you like kind of German style law, just look for Austria. They did it properly, we didn't. Okay, so wherever we did something differently, this only creates problems, ambiguities. So my recommendation would be regarding the further development of the Ukrainian CF0s, just stick to the ATAT, and you're probably going to be good with that. And it actually leaves a lot of flexibility. So really, if you stick to that, that's cool. But there's really not too much in the German system that I recommend to copy, with one exception, and that is this considering foreign CFC taxation in your own system. That is a good thing. This is the one good thing we have there, okay? So, yeah, that would be my presentation. So, dziękuję za uwagę, do popatrzenia, or if you have any further questions, I'm glad to answer any further questions regarding the German tax system. Thank you very much.
Thank you, dear Professor Moser. A lot is a very interesting presentation and productive discussion. We would be very grateful if we can count on cooperation with you in the future.
Absolutely, yeah. I would be glad to have further preparation. Thank you very much.
Thank you. On behalf of our university, I would like to invite you to join an organizing committee at the conference devoted to the financial aspect of European integration in April 2023.
Thank you so much. Thank you so much.
Also, we will be happy if you can hold a presentation at that conference. Very interesting.
Yep, I think we will just discuss that kind of the scope and stuff in the future. But thank you very much for the invitation.
Thank you.
Thanks again. It's really good, and till your Ukrainian is perfect.
Oh yeah, I just pick up some words. Okay, so but thank you so much.
But it's nice. Yeah. So I guess we don't have any other questions, and I guess we already started having problem with electricity because I see that people just drop in.
Okay, so then then thank you very much for the attention and for the excellent questions. And yeah, I guess I'm going to hear from you. Thank you so much. And yeah,
bye-bye.
Thank you so much.
Thanks
All
again.
the best.
Yeah,
Bye.
thanks again. Stay in touch. Bye. Ну, Оксана, все нормально.
Я половину слов забула, по-моєму.
Нічого страшного. Ні, тут же головне увага. І тепер він ваш навіки.
Ти його заболтала, а я ще добавила.
Увага, щоб це йшло від вас, що це живі люди, які якби engage, так що все по барабану, що там забула слово, нічого страшного. Вони взагалі дивляться на українців, як дійсно люди-герої, як ти тут слова не забудеш, коли живеш в такому стресі, так що все норм.
Я тут боюся, що ще світло вироблять на кожному слові, поняла?
Нічого, все добре.
Фух. Ми це зробили. Дякую. Так, дякую. Все, по статтям пропишемо ми там, да, все?
Да.
Тоді. Пока-пока. Хорошого дня.
А вам спокійного дня.
Дякую. Це дуже важливо.